Katanga, a very interesting take here. What are the impact of these changes, you think?
Well, we knew that the Biden administration, the regulators, particularly the banking agencies, would pull across the finish line a comprehensive capital reforms. But what we didn't know was specifically how those rules would impact the mortgage market. We're learning, based on sources familiar, that as soon as next week, we can see a proposal that will still have to be open for public comment and will certainly be subject to much criticism by the industry. But we'll understand exactly how various asset classes will be impacted by the broader capital reforms that were contemplated by Basel, but that the U.S. still have to impose themselves.
Okay, so that's the roadmap.
Okay,
what happens next?
We anticipate that once the proposal is unveiled, we'll expect regulators to seek public comment. They'll have to then set a date. We understand that could come as soon as early next year for the final rule to be adopted, and the implementation process may still take years. All told, though, what this sort of measure will require is for banks to put more capital aside to help buffer against any potential defaults or losses. And while there are certain standards that globally that banks of all sizes will be imposed to, the U.S. standards go just a little bit beyond. In this case, we knew that on average 20% of capital overall would be put aside. The news we're telling today is that with respect to mortgages, all the buckets around the various types of mortgages will be assessed for how risky they are, and the administration really wants to see an added 20 percentage points per bucket, if you will, of mortgages that big banks and all banks of $100 billion or more will have to set aside.
All right, Katanga, then maybe walk us through what the winners and losers could be from these sort of new regulations. Who stands out the most to you?
In many ways, we can expect the biggest banks to really be impacted most, not just because of their size, but also because under current regulations, there are cases where potentially, depending on how risky the mortgages are for those banks that they hold, it may be that they could have held less money aside compared to banks that were under the $100 billion mark. But these regulations will require them to put even more aside than they had been anticipating. And perhaps, even though it will take place at some point in the future, banks should start thinking about what that sort of calculation might look like. And even beyond just the banks having to put more aside, and that's obviously, in their view, a loss, we can expect riskier borrowers, American mortgage consumers broadly, to just know that they're getting this for the same types of loans, mortgage loans that you take at a big bank, you can also get it comparably at a smaller bank.